Hey everybody, it's Mike over at Taxes and Bricks. Welcome to episode 37. Today we are continuing our three-part series with our final part on withholding, and we're going to talk today about state withholding a little bit. Just a quick reminder, if you like this kind of content, don't forget to hit that like button below. Don't be afraid. Just hit that like button. And you can subscribe if you haven't already. Share our content with your friends. And definitely leave a comment or question in the comment section below. I read and respond to all of them. To take a quick break here to pay the lawyers. And then we're going to put up a little disclaimer. Come on back. And we'll continue on with our discussion of withholding.
This video is rated TAX and contains occasional ramblings, mild attempts at humor, self-deprecation, irreverence, brief numerical examples, and adult tax and accounting advice that may not be suitable for all taxpayers. Viewer discretion is advised. Before following any of the advice in this or any of our videos, you should always consult with a tax professional. Thank you.
All right, so welcome back. Now, talked a little bit about federal withholding in the last episode and why it's important. And people tend to focus on it most because it tends to be the larger percentage of tax, tends to be kind of like the most scary thing, like, oh, the IRS. And since state taxes are usually smaller percentage-wise, people tend to kind of forget about them. But then they realize they're in trouble. Okay, maybe their federal returns are fine, but they just got all these state problems. And I think that, while yes, that's true, the federal government is a much sort of larger entity than the states. I mean, maybe not, I guess, collectively if you had all the states together, but certainly for the average person who deals with one state, the IRS is much larger than that state government taxing authority. The states become complicated because the IRS has one set of rules, and everybody in the United States who files a United States tax return adheres to the United States Internal Revenue Service Department of Treasury rules. But somebody in Arkansas is following the Arkansas rules, and they may encounter New York, and they may also encounter, Arizona, and they may also encounter Alabama and, Hawaii. And so it's possible that, you're only going to have to deal with your own state, but it's also possible you're going to have to deal with somebody else's state, okay? And as many taxing authorities that exist will all have their own set of rules, and the states all have their own kind of, guidelines. And some of them have rules about, well, if you work in their state but you don't live in their state, you do pay taxes, you don't pay taxes. If you're there only maybe one day, maybe you do pay taxes and don't pay taxes. What is a day? Okay, is a day just you went up at 8 a.m. and you worked for the day and then you came back by 5 p.m. to your home state? Maybe it's a border state, something like that. Maybe the state that you live in has a reciprocal agreement with the state next to it. And so you can go into the next state and work and not have to pay them tax. Or maybe you have to. There are a lot of different rules and regulations, okay? And we're going to talk a little bit about some examples. And then we're going to talk a little bit about some strategies on how you can kind of monitor your state taxes a little bit. And then what to do if you're running into problems, what to do if maybe you think you're getting some bad information from an employer, okay? So, in general, and I say this in general, the state where you live, physically sleep at night, have a driver's license, your family's there, your kids are enrolled in school, you vote, you get your mail, your cars are registered there, you own a house, you rent a house, you have a lease, wherever. That state is going to be your tax home. And that is the state that is going to have jurisdiction tax-wise over you. Okay? In general. That doesn't mean that other states can't put their hands in your pockets under their tax codes. So, you may have a situation where, I don't know, you're a Virginia resident okay? And your job's here in Virginia, and you live in Virginia, and your spouse is here in Virginia, and your kids are here in Virginia, you're a Virginia resident. So Virginia's got you tax-wise. But every couple of months, your job sends you up to New York to work for a week, and you stay in a hotel, and, you come back, though. You're not establishing residency and whatnot in New York, of course, because you're only going up every couple of months for about a week at a time, and then you come back. Well, sorry to say, New York's allowed to tax you on the income that you earn while you're in New York. That's it, okay? A lot of states are like that. They have non-resident taxes, okay? So be aware of that. If you're going to leave your jurisdiction, okay, you want to talk to your employer, you want to talk to an accountant, probably before you go, but if there's not enough time, certainly after you get back. Hey, am I going to have some obligations? I had to go to Kansas and work for a couple of days and whatever. Am I going to have any obligations? Huh? Real simple. Every state's got a non-resident, tax rule. We just crack open the rules about non-residents. They're actually usually pretty simple, and we look at them. Well, maybe that's not the situation, though, okay? Maybe you're a Virginia resident. You live in Virginia. You never leave Virginia. You stay in Virginia, inside the lovely borders of the Commonwealth of Virginia, and you never leave. But maybe you own a tiny percentage of a partnership or a business that's located in California. Maybe California. Go to California, but the business is located there. The business generates some income. It has an operations business hub in California. Maybe it's got an office. Maybe it's got California customers and clients, and you're getting a share of the profits. You may not be in California earning those profits, but got California source income. California's probably going to be able to tax you. Okay? So is this all bad? No, it's not all bad. I mean, it kind of sucks. I really wish the states would just leave people alone that don't live there, but I get why they do this. Okay? The idea here is that if you are going to be subject to tax in another state, you should know about it either in advance or shortly after you figure out that you might be obligated for it. Okay? Got to figure out if maybe you need to pay them in advance, or you got to have taxes withheld because you don't want to end up with, penalties or whatever. And in terms of, the state taxes and whatever, you want to make sure that if you are withholding, you're withholding in the correct locations. Okay? So always important to know that. But that's more of a precursor to the problems I see. The problems I see with respect to withholding on the state levels are most of the time that people don't have withholding in a state that they need to pay. Mainly because they either don't know or their employer doesn't know. And they find out too late, like when they're sitting down to do their tax return. Or their employer is withholding in a state they shouldn't have had withholding in, and not in their home state. I see this all the time, and especially if you have states that border one another where, either your office is located in another state and you drive there, and you live in, say, Virginia, and you're driving to Washington, D.C., and your office and your business is in D.C., and they just don't know any better, so they're like, well, it makes sense, might as well, he's working in D.C., and so working, taxes, working, we're going to withhold D.C. taxes on somebody who lives in Virginia. No, not in this case, because Virginia and D.C. have rules. They have agreements with one another where Virginia agrees not to tax D.C. residents who come into Virginia and work, and D.C. agrees not to tax Virginia residents who come into D.C. to work. Okay? W-2 jobs mainly is where these reciprocal agreements exist. All right? So you got to be careful. You got to be careful when you're crossing jurisdictions that you're withholding in the right place, and also that you're not withholding in the wrong place. Because what happens in a case like this is that, let's say in that example, somebody had a bunch of D.C. taxes withheld, but they didn't live in D.C., they worked in D.C., okay? They lived in Virginia. Well, they haven't had any Virginia taxes withheld all year. So now they get this massive amount of money they got to send to Virginia on a year's worth of income, okay? And then they got to ask DC to give them their money back, and then DC is going to have a form, and you're going to have to mail it in, and you're going to have to ask them nicely, and then you're going to have to beg, and then you're going to have to give them a pint of blood, and, you sacrifice your firstborn and whatever. The states hate giving up this money. And I'm not going to say this in sort of a craven way, but I think that when they see these requests for refund for non-residents, I think a lot of them get very skeptical, and you can tend to get a little bit of pushback. I also find in my experience that when you're a non-resident requesting a significant refund for all or pretty much most of the taxes you had withheld from a state you didn't live in, the refund takes a lot longer to come back than if it was just a standard request to the state that you do live in, okay? And that can be a huge problem. So what can you do to kind of monitor all of this and make sure that your state taxes are actually being done correctly? You're going to hate this because everybody does. Get copies of every single pay stub every time you're paid. Most places don't hand out pay stubs anymore on a Friday. Most places just make them online. They're available online. Just take 5 minutes after you get paid and make sure that the state income tax withholding on your pay stub is correct, okay? And if you're not sure whether it's correct, give the pay stub to an accountant or somebody who knows this stuff, or maybe talk to somebody in your HR department if there's a tax specialist there, because they're going to be able to look at this and tell you whether it's right if you're not sure, okay? So look at your pay stubs. Look, they usually will tell you. There'll be a little 2-letter abbreviation for the state or jurisdiction, okay? Something else you need to pay attention to. A lot of places have local taxes, so it's not just the state, okay? One place that comes to mind is Maryland. Maryland's got a state income tax on the state level, but they also have county taxes. Some employers don't take the county tax. They just take the 3-4% state tax, and they skip the 3 or 4%, or in this case, Maryland's 3% county taxes. Pennsylvania is another one. Pennsylvania's got municipality taxes if you live in Philadelphia. They've got township taxes. There's some county taxes that go in. So Pennsylvania's easy because I think it's like 3.25% in state income tax. It's just a flat tax. They really don't have any deductions. So most of the time when I do a Pennsylvania tax return for a Pennsylvania resident, there's nothing that comes back. There's no balance due. There's no refund because they just withhold the exact amount you need to withhold. It's the Philly tax because somebody worked in Philly but lived in a different county, and the employer maybe didn't know to withhold Philly, or maybe they just withheld, I don't know, where the main office campus was and not where the employee actually is. Be mindful of all the little locality taxes, because as many state income tax regulations and tax codes as there are like 10, 20, 50, 100 times more local taxes that you got to deal with, okay? So really important. You can also change your state withholding the same way you change your federal. Most states have a version of the W-4. It's going to be called something different than a W-4 in most cases. Also, states will take estimated payments like the federal government. So if you're having state problems, or you can't get your employer in line with withholding in the right place, I've heard this a lot. Well, my employer does their own payroll and they don't feel like withholding in Maryland because I'm the only Maryland employee. Everybody else lives in, Ohio. Okay, no, and your employer really is kind of, being a bad kitty. But if that's going to be the case, then you should be doing it on your own. Don't withhold in Ohio if you're not there, okay? If everyone else is there and the company's there, but you're actually stationed in Maryland and that's where you live, don't be withholding in Ohio. Don't let your employer do that. If they're not going to withhold Maryland, though, you need to make the payments. Figure out what you're going to owe. Figure out what the state rate is. Figure out what the local rate is in your county, and send some money every quarter. Most of the state governments will take that money by check. Most of them will take it, online, like similar to the direct pay website. Most states just have a website. You can go in, you can create an account. Some of them don't even require you to create an account to make a one-time payment. No big deal. Very simple stuff. Okay? So, bottom line, state withholding, I think it's important to pay attention to. I think it's a little bit more complicated because while the rates are probably pretty standard and much lower, I think that there are a lot more jurisdictions you got to pay attention to. And unlike the Fed, where there's just one Fed for everybody, you could end up, obligated to pay taxes in multiple locations, multiple states, okay? Make some estimated payments, adjust your, state level W-4, okay? Pay attention, watch for your pay stubs, look at everything, and I think you'll keep yourself out of trouble. All right. Hey, thanks for watching today's episode. Don't forget to like, subscribe, leave a comment in the comments section below, and we'll talk to you soon.